Hello, this is Jonathan Mickles with Red Boot LLC, and today I have with me Dan Kay of Rocket Dollar. And essentially, in another session, we had talked a little bit about self-directed IRAs, and I know I had taught some things some years ago about self-directed accounts, but there have been some new developments, things probably as old as that knowledge that I had. But I felt it best to just want to put together a webinar specifically with an expert in the field to introduce what the concept is for those who may not know what it is, what self-directed IRA or self-directed accounts are, and the types of accounts and a bunch of other stuff. So with that being the case, I'm going to turn it over to you, Dan, to talk from your perspective, and you have the floor there, sir.
Wonderful, John. Great to be with you once again. All right, so let's just get to it here. And all right, folks. Hopefully you can see the pretty purple screen and not, as they say, my big head, as I'm told by many folks. But yeah, so we're in an interesting time here, April 2020. So this will kind of be some of the reference points that I have. A lot of things that have been shared, we as a company at Rocket Dollar, from launching 2 years ago and many years before, have felt this way. And I think now we are starting to see the proof points, and frankly, where we as individuals and as a country are going in terms of taking back control of your retirement dollars to invest in what you want, when you want, to impact yourself and your community. So, with that, I think as we think of, retirement, and trust me, it's not that far away. What are we doing with our money? Is it really working for us? Not to be too blunt, but I mean, having your money in a passive mutual fund or target date fund may have seemed great for the past 10 years, but like anything, when the shoe falls off, it falls off pretty hard. I mean, knowing that all these gains were erased, and now probably looking at a pretty stagnant stock market, is that where your money should be? Probably not your personal money. I'm sure that's not the priority. And then likewise, what about your retirement dollars? The second thing I think is fees. As I said, the curtain's been pulled off the Wizard of Oz. As much as I respect the advisors out there, if they have not shared that there's self-directed accounts, then they provided you a disservice over the last few years. So us, as we viewed it, you should not be penalized because, let's say you have a lot of money or not as much, or God forbid you make a good investment. That's all off the table. And then finally, what opportunities, are you missing, or what's something that you haven't been aware that, as you say, the Joneses across the street, or the true high net worth folks, the family offices, have been taking advantage. Well, I want to share with you today that all of this, has been legal and around for the past 50 years, and now is at your fingertips. All right, so as we see it here, what is the problem? The first thing is folks naturally want to buy alternatives, meaning I know a lot of folks may have a second property. At the very least, you probably gave a loan to one of your colleagues, invested in a female entrepreneur, invested in an underserved community. This is how we're naturally wired. We're good-hearted. We're also very smart financially. So you do this naturally with your piggy bank checking account, as I say. How about doing it with your retirement dollars? And the reason why was a factor of awareness. Folks just weren't aware. As I like to say, even here in Texas, it was not country club cool to tell your friends about some of these old stodgy custodians in the space. And, as I share, and the cat does look bored. This was a difficult, onerous, very, I think, paper heavy. It just was not smooth. And I feel, all of that has been changed. So, here's the big thing, historically, and maybe a lot of you folks have been directed over the past 10, 20, 30 years to be in the 60-40 stock bond split. Even looking at it, that kind of looks a little drab, as my uncle who retired from the DOD, this kind of looks like East Germany, East Russia, the whole Eastern Bloc here, the kind of bland grays, whereas you know, the pretty pie chart. And you can even ask a 4-year-old, what would you rather, two shades of gray or multiple colors? I think multiple colors is the way to go. So, yeah, you're still going to touch a bit of stocks and bonds, but real estate, startups, crypto, hard money loans, you can do all of this in a checkbook controlled, self-directed IRA. So, the solution here is really unlocking the money, and it's comically huge numbers, in the trillions. I know it's becoming commonplace to hear this in the headlines, but, another way to say 10 trillion is, 10,000 billion, or 10 million million. It's just really crazy. And that is what I consider the amount of money sitting on the sidelines in these, funds. As I said, it's been around since the 70s. Thank God we are not in Washington, D.C. trying to get anything passed these days. It's been around. Many politicians have benefited on both sides of the aisle from these accounts. They're not going anywhere. If not, you are going to be able to contribute more, and these will become more advantageous to you. So, first, what I want to show is just how quick it is to open the account. And why I show this is historically, you would need a scanner, a fax machine, fill out a bunch of questions, and probably take, X hours over a few weeks. Already in the past 30 seconds, you just signed up for a Rocket Dollar account. Congratulations. It really is that simple. From here, and this is all patent pending technology in the background, you can move money, you can transfer, and then invest in what you want when you want. So let's look at a real example. Let's say, you worked at company A, you put money into a Roth account, it sits now at Charles Schwab. You learn of let's say a self-storage deal of all things, to invest in, and you need to move that money over in 2 weeks. Well, boom, here's a very easy way to transfer over the money. And then finally, so what's in your account? Well, it's probably going to be a diversified mix over time. Some folks come with just one investment here. Somebody has been heavy into a peer-to-peer loan, real estate startup, and now they're investing in a restaurant down the street. Maybe you say, okay, now's the time to really support one of these businesses here, or maybe you're buying, a depressed asset, something that financially could make a lot of sense. You're just tracking it all right here. So all within one platform, this is. So, with that, the big question is, wow, so what does this cost? Where is all the fine print? So let's first talk about what these accounts are. So, I'm going to start with the IRA. And IRA is the Gatorade term out there. You probably heard the acronym or seen SDIRA. It's Individual Retirement Account. And basically what this means is, as it sounds, you as an individual have a retirement account with many, and kind of working right to left across the screen, many tax advantages. But then I'd say the other three columns here is what is unique to a self-directed IRA, particularly a checkbook control self-directed. The first thing here is what I really want to focus on is the fast transactions. So when we talk checkbook control, it is as it sounds. Your money sits in a checking account. You have full access to your money 24/7 to wire ACH or to do an old school check to invest in what you want when you want, which, as we said, is real estate, startups, private equity, and much more. And likewise, you can still do that $6,000 a year contribution. And I'm sure over time we're going to see this go up. And if you're over 50 years old, there's usually an extra 1,000 or so that go into it. All right, so that's great. And everybody in America is eligible for one of these accounts. Now, next up, this is kind of like the eye test. Not much has changed, which is good for this solo 401k, also known as the individual 401k, the EQRP. What is so amazing about this is if you are self-employed, so let's say historically you have been a consultant, a husband-wife team, maybe you own a florist, even if you are heavy in the gig economy, due to current situations, a lot of folks may be 1099 this year and maybe find it very opportunistic, maybe to be a 1099 salesperson, a turnaround expert, thinking of a new idea that you will be compensated on. What I want to share is two things. First and foremost is the high contributions. And no, that's not a typo. That's literally $62,000 a year. I'll talk more on that in a moment. But the other thing, particularly in this environment, you can borrow up to $50,000. So let me be very clear. You can borrow up to $50,000, the lesser of that or the value of your plan. So as long as you pay it back over 5 years, no additional taxes, no penalties. Why this is tremendously advantageous. So in quote unquote normal times, or I should say pre-2020, I know a lot of entrepreneurs said, you know what, I kind of need 25, 50K for this idea. I don't want to raise money. I don't want to ask my friends and family yet. I'm going to try this. I'm going to borrow money. If it works out, great. We have a great business. If not, I'll probably go back and get another 9 to 5, and then over time, we'll pay this off. So that's extremely powerful. And you can do whatever. And in these days, 2020 plus, some folks say, I might really need this 50,000. I feel very confident in myself that I could pay it off in 5 years, maybe not in the first year or two. So as I said, this is your money to do what you want with it. Some people turn around as an investment. This may need food and rent in the near term. As I said, once again, you pay it back. So let's use a very real example. You borrow 50,000, you can only pay back 40 in the 5 years. You only pay, call it a penalty on that $10,000 difference. There's a lot more in Rocket Dollar's knowledge base, rocketdollar.com/learn with examples. But I just want to make folks really aware, because I would say this year across any other, there will be many folks with eligible self-employed income that will qualify you for the solo 401k. And once again, it's huge what you can contribute. So this is, 56,000, 62,000 if you are 50 years or older. Multiply this by 2 if you're married. So let's use a very simple example. Say you make 100,000 as self-employed freelancing this year. Right off the bat, you can defer 19,000 like your W-2 friends, and then 20% of your net earnings. So in this simple example, on 100,000, you can defer 39,000 off your taxes right off the bat. So I said it's very powerful. And as I said, I think a lot of us will be in the position to open a solo 401k this year, or as naturally as we move on, I think folks will want some sort of second source of income. And if it's eligible income, you would qualify for the solo 401k. All right, so finally, this is not some torturous thing that I made my intern do, but this is to show, and Rocket Dollar has 2 different tiers. This is for the core product that we've launched on day 1. And it really is that simple. Rocket Dollar's on the left. It's the one-time upfront, and then $15 a month flat. As I like to share, it's like Netflix. Whether you need it for one investment or you're going to be in TED crowdfunding, that's all that it is. Let me slow it down a little bit here. And as you can see, once again, the right side of the screen, this is just what other folks in the space have been doing. It's true nickels and dimes, but actually these are pretty heavy, and this adds up, versus Rocket Dollar's flat $15 a month. So, whether it's Rocket Dollar or somebody else in the space, I think we want simplicity. We don't want fine print at this point. So I would look for folks that do have a flat fee, for Rocket Dollar, frankly, many other things in financial services these days. So, with that, being that I'm from Philadelphia, from the city of brotherly love, I would love to, as I say, if you can spell it, you can get it. D. Krzyzanowski, it's 12 letters, you see it there. Especially in these times, to offer up to $100 off your sign up. And I'd love to talk more. As I share, I'm even sharing my personal cell phone here. Any questions, I do understand the times that we're in. Plus, I'd love to share education, talk about this. It is there. And then once again, real simple, Dan, D-A-N, at rocketdollar.com. So with that, folks, thank you. And John, love to kind of reopen it up to any sort of questions or that may have come in.
Yep, got a couple of questions. Number one, you mentioned that it was a $15 per month yearly fee. Can we pay that, or monthly fee, $15 per month? Can that be paid all up front, or is it going to be just deducted from my self-directed account, or how do I set that up?
Yeah, great question. So it's the one-time upfront. So let's say with our core product, it's the 360 and then 15. So yes, the first month, let's say it's January 1st and you're signing up, it'd be $375, and then this scenario minus $100, so $275. And then ongoing of the calendar date you sign up. So let's say you sign up January 20th, it'll be February 20th, $15, but it's $15 flat. That's regardless if you have, one asset at 10,000 or you roll over $500,000 and you're in 10 different investments.
Well, I guess the question was, can they pay the $15 per month as a yearly single one-time fee?
Sure. Great. Sorry about that. Yeah. At the moment, no.
Okay.
And, but I would say the fee comes out of credit card. And this is actually from feedback from the audience. One, it's, it's smooth throughout the year and it's kind of a latte or two sort of price. And secondly, which I think is more important, it's not coming out of your balance. And why this is, a lot of folks tend to have a round number, especially they move maybe 5,000 or 10,000 into a Roth. As I said, we don't want the nickel and dime. Somebody moves over 10,000, then be like, oh, all these fees came out, but the minimum to invest in one of these real estate deals with Red Boot is 10,000.
Right.
So that's part of it, why it comes out of your credit card.
Not a problem. You mentioned when you were describing the solo 401k, the EQRP. Is that the same thing as a solo? What does EQRP stand for, first of all? And then,
yeah, it's a fancy acronym that somebody else who's been in this space for a while have. But the individual 401k, effectively they're the same thing. You as a passive, basically, if you have eligible self-employed income, it qualifies you. And the one minor difference that I know we talked in detail on the podcast is with the self-directed IRA versus a solo 401k or EQRP, if a certain real estate deal is structured a certain way, you may be liable to some of that taxation. That said, for me, in dozens of personal investments, it has not hit me. The acronym is UBIT, UBIT, as once again, rocketdollar.com/learn, type in UBIT, and you can learn all you want about it.
Okay. Next question, you mentioned, that Rocket Dollar is a checkbook 401k, and that's different from a custodial. And I think some of the self-directed companies that initially came out were more custodial than checkbook. Just highlight the difference again for our listeners, just so they understand the difference between the two.
Absolutely, and thank you. So first, custodial, I kind of shrug my shoulders when I hear that. Somebody is taking custody of your money. Your money, let's take a very real scenario. You work for company A, your money's in Voya, and then you're at company B or C, it's at Fidelity these years. You want to move it to a self-directed account. With the custodian, your money will, after doing all the paperwork, taking a few hours to finally sign up, your money will move. And then when you want to invest, you basically will have to ask them for your money back, fill out a bunch of paperwork. The deal sponsor you're investing will have to fill out. And then there could be, sometimes it's quick, sometimes it's not. I've seen things go as far as months, sometimes as years before somebody even gets access to their money again to invest. That is what a custodial account is. Now, a checkbook, as it sounds, it's you have access to your money 24/7. The best analogy I can give is like a health savings account. It's probably backed by some credit union or community bank. Your child breaks his or her arm, you go to the ER, you can use that account right there. Same deal. You think, hey, I want to go online to a crowdfunding campaign at 3 a.m. Guess what? Sign up, move the money over, and it's all there. And the second thing, you talk about custodial self-directed IRAs, realize Rocket Dollar is checkbook control, self-directed IRAs, and then also the solo 401k. So two different account types. And the final point I'll make, really in the weeds here, but in the solo 401k, you can have a pre-tax, a checking account portion denoted for pre-tax and another one for post-tax. Whereas in the IRA, now with Rocket Dollar, otherwise you would need a pre-tax, aka traditional self-directed IRA, and then a Roth self-directed IRA.
Okay, that is in the weeds again.
And that's 2 times the fee. So I just want to be as transparent as possible, and you can thank our friends in DC for that. So.
I understood. And again, if you have any more questions about this, feel free to reach out to Dan directly at dan@rocketdollar.com. But I have a couple more questions that have come in. I guess one is a statement that I saw was, pretty much you mentioned investing in your community. And again, when we're recording this is April 2020, but this could be for just any time. There are some businesses that, are badly affected, or some businesses that would like to start now as a result of what we've endured here in this 2020 phase. And so one of the ways that we can assist those businesses, whether that be a food truck or, a salon, whatever it is within your community, you could use your retirement savings to make that happen. and invest within your community, which is a
Mhm.
good segue into my next question. Say, we have somebody who has, I don't want to describe their specific example here, but they have a retirement account. Do they have to self-direct all of their existing retirement money, or can they just do a portion or a chunk, say maybe that they can use to invest in an organization?
No, great question. No, it can be a portion. I mean, it can be as in very good faith. I think if folks are bringing in 5,000, are committing to say, I'll have 10,000 in the account within a year or two, uh, that's great. On the flip side, we've seen folks move over $1 million. It's quite a range that we see that comes in. And as I said, 20% of our account holders have two accounts because maybe let's kind of go full circle on this. Let's say there's a female entrepreneur and then a company in an underserved community. Uh, maybe with one of the investments, you think this is going to be the next Facebook. Well, guess what? That 10,000 you've had sitting in your Roth for all these years can go into a Roth account and you can invest. Let's say the other investment, maybe not, you're questioning a bit of the business idea, or maybe it's not proven out yet, is a better way I can say. But I hate to say, but worst case, it's coming from pre-tax traditional dollars that you never pay taxes on.
Right.
So, if you put in, say, even if it's a loan of $1,000 or $10,000, worst case, if it goes to zero, realize it's not like, um, you pay taxes on that already. It's still from pre-tax money. Now, that said, I will preface like any investment, do your diligence and such, but this is a great time where you have two buckets of money that have been uniquely taxed or not taxed before that you can choose out of.
Okay. Two questions I think I'm gonna take, and then we'll be done.
Sure.
You had a distribution, in the old days it was 60-40, 60 stocks, 40
Mhm.
bonds, and then you showed a slide where there were, more, if you will, a bigger pie that
Mhm.
was sliced off in terms of the type of distributions. Where did that distribution come from? Yeah, that's part A, and then part B, you mentioned 10% in hard assets
Mhm.
that were separate from real estate. And could you explain what those hard assets were? So part A,
Sure.
where did you get the distribution from? And part B
Mhm.
is what are hard assets and how are those different from, say, real estate?
Sure. So I'll go back to my, Philadelphia, pride. So I hate to say it came from Yale, those folks in Connecticut, but I think it's the Yale Endowment, our great paper published by Yale that really looks at high net worth families, uh, family offices, private kind of serial private investors. And what we've seen is that, I said multicolored pie chart, where frankly, some of them even have the stocks and bonds shrunk to almost zero. It really, they play up heavy on. I've seen a lot of bar charts even on LinkedIn as you make more. I mean, that really goes from, the 60-40 total of 100 down to basically zero. It's really fascinating to see. So those are some of the sources that we had. So that may not be the exact numbers, but it's just for directional. And
Sure.
then, secondly, on the, hard assets, gold, you have to be careful sometimes with gold and coins, which ones exactly where to store. That said, there are some sort of turnkey providers out there that are it. That said, I said the nice thing about this is the private loan that you can do. I mean, I have a buddy, he has this dynamic thing that can revolutionize swim training. He just has to pull over some inventory from China. And so he's, I may, or there's in our community may give him a loan. It's backed by a hard asset, so like kind of asset-based lending that you can do it on. So I mean, you don't want to play lawyer or get highly litigious on kind of a simple loan, but if it's somebody you know and trust, and you guys can agree on a, I would suggest a collateralized one-page contract. Yeah, you can do it. And then John, as you mentioned, I mean, real estate, you can see it, feel it, touch it.
Yeah.
It's not probably not going anywhere. So I think that's, especially in this environment, it's something you probably want a little bit of tangibility.
Yeah, and to put a plug in for Red Boot, and I've been trying to just make this solely for those who are listening, rather than just to put in a plug for us.
Mhm.
But in BC class, real estate C class is pretty much kind of the workforce housing. That stuff is not really going anywhere, and if anything, the demand is going to go up, as time goes on, because um, the affordability of housing at the present,
Yes.
is really outpacing people's ability to be able to get into housing, let alone wanting to take on all of the things that go along with owning a home. And so if that's the case, then again, C class, B class housing is going to be out there for the masses. And I think, with Red Boot, focusing in on BC class housing with value add, meaning that there is, some things that we can do to make the space a little bit better for the tenants, represents, I think, a long-term viable asset that people could potentially invest in. So
Sure.
again, talk to all of your people, but we'd love to have you over here working with us. Final thing, and I think you've mentioned this before as it relates to, because we've used a lot of terms, and again, you can always go to the Rocket Dollar knowledge base to find out more. But we talked about the self-directed space, and then there was two legs. One was kind of the custodial leg, which is pretty much what has been in the past, and then the checkbook community, which is what Rocket Dollar falls in. If we go up one level, there is a difference between a traditional, say, Roth IRA and a self-directed Roth IRA. So what is the difference between, say, Charles Schwab or, just a regular IRA and then one over here that's self-directed?
Sure.
Yeah.
So let me try to break it down. Kind of, typical American, where your money is. So as I alluded to before, you work at company A, your money probably sits with your 401k provider. Let's just call it Voya. You leave that company, they said the money has to move. It probably moves into a Fidelity or Vanguard. And at this point, it goes from your company's 401k, company A, to a traditional IRA, probably called a rollover IRA, because you are rolling over from a 401k to an IRA. And you're limited within this portal, say of a Schwab, of a Fidelity, what is on their platform that you can invest in. You cannot do Red Boot. You cannot do, a loan to somebody in your community. Now, when you move over to the self-directed world, what is most common, you're going from traditional to traditional, which means pre-tax to pre-tax. So trust me, the IRS will take your money anytime you want to give it. You're not mandated until you're at least 70 years old to give a little portion of it away. But at this point, most folks are still staying where they're just deferring taxes as long as possible. Now, a separate scenario is that, you're working your W-2 job, let's say, and you're saying to put $5,000 in a Roth, and you do that for 2 years. And then that's at Fidelity, same deal. You open a self-directed IRA. Now it's already Roth. You paid your taxes. So you better hope, of course, the seed versus tree analogy, you pay taxes on a little seed and this 10K, turns into $1 million, whatnot. So you don't pay taxes on the back end. That's very common. So what I just shared is a scenario on why I'd say 90% of our account holders with two accounts, that is their direct scenario. Now, a final point that I'll share is, let's go back to the initial scenario where the money, went from your Voya to your Fidelity to Rocket Dollar, all traditional. But let's say you're in the solo 401k, you're self-employed, and layperson's term, underneath the same umbrella, just for the $115 a month fee, you can have a pre-tax traditional, so traditional, AKA pre-tax, vice versa, and then a post-tax, AKA Roth account designated under your solo 401k. Why might this be important? Let's use round numbers and said, somebody's going to move over 100,000. Great. So, you had your job, you moved to Fidelity, here it is at Rocket Dollar. In a solo 401k, I'm going to put, 50 with Red Boot. And that's great because I love the dividends coming in. That's very secure. I can do a loan to somebody out of my community. And then finally, there's just a startup I had a really good hunch on. You know what? I'm going to invest $10,000, but I want it to be in a Roth account because I feel, this is going to be the next Facebook, as they say. And I'm not recommending to do this blindly. This is just for purposes of example, but just as easy as online banking, move from checkings to savings, you would move over. Now that said, once again, the IRS always wants the money when you want to give it to them. So if you are doing, this is called a Roth conversion, when you convert from pre-tax traditional to Roth, you will pay on that, in our example here, the $10,000 or whatever money you move. Why may this be advantageous? So this might be for some more of folks of higher income, I know between now and 2026, up to $315,000 is the lowest marginal tax bracket. So to all my entrepreneur friends out there that, you're just taking equity in year one, I personally did a six-figure Roth conversion, and I hope the company is still standing in 20 years because I did that, and I do think it is, of course. But yeah, I mean, part of that, there's a lot of strategic ways, and I won't go into deeper detail. But the main point I want to make here is that, it's two things. It's one of the, going from very tight limits in like a Schwab world to literally having the world at your fingertips of what you could invest in, and then also having, particularly if you're self-employed or have eligible self-employed income, to have kind of these two checking accounts to have the ability to see what source is going to come out from. And, what I've been doing recently, as I've got to know certain real estate players such as Red Boot and others here, I'm putting in my Roth money, that post-tax money, because for me, this is still the seed versus tree analogy. And trust me, it's a lot more secure and good on the old ticker than, a startup. So I think you're going to see folks that, it may be wise to convert sooner than later. So, of course, happy to go into further depth with anybody one-on-one on that.
All right, that's excellent. Listen, thanks again, Dan, for your time. I know you're a very busy guy. A lot of people are making phone calls, trying to figure out what they can do with their money in this time. So again, if you have any questions about, self-directing any or portion or all of your assets, feel free to reach out to Dan K at rocketdollar.com. If you have interest in Red Boot LLC, you can email me personally at jm@redbootllc.com. Or just go take a look at our website at redbootllc.com. Again, thanks so much, Dan. We look forward to talking to all of you guys soon, okay? Take care.
Yes, sir. Stay safe. Peace.
Bye.